Hello, welcome back to this week's market update. Today is Monday, November 10th, 2025, and we will jump right in. Looking at last week's market performance, stocks fell as signs of strain appeared in both the labor market as well as consumer sentiment data. The government shutdown also became the longest in U.S. history, with its economic impact deepening as hundreds of flights were canceled and another month of BLS jobs data was missed. As of Friday, November 7th, the Nasdaq Composite fell the most, 3.13%, its worst week since April. The S&P 500 was down about 1.7%, and the Dow was down 1.25% last week. Heading into last week's economic news, we did get both the ISM Manufacturing and Services Indexes for the month of October. The manufacturing PMI came in slightly below expectations at 48.7%. So anything below 50 is typically considered bearish. Anything above 50 is considered bullish. So this is a slightly bearish reading here, continuing a long-standing trend of contraction in manufacturing. This was led by business activity, new orders, employment, all being below 50 there as well. We did have one positive category, which was supplier deliveries. That was up to 54.2%. And then we also had prices showing above average inflation as well. In contrast, the ISM Services Index came in for October better than expected at 52.4%, so slightly bullish on this front. This was mainly due to pretty strong business activity and new orders. As you can see, those are well above the 50% mark. On the other hand, employment seems to be weakening a bit at 48.2%. Supplier deliveries, pretty neutral there. Inventories, about neutral at 49.5. Prices, quite inflationary there at a reading of 70. So we're seeing still a lot of inflationary pressures on the service side of the economy, but that makes a little bit more sense as business activity has been stronger. Overall, though, we can see a lot of disparities between the manufacturing and services industries, with manufacturing being pretty weak over the last few years, services being pretty strong. So we'll take a look at the longer term trend in the next slide. Looking at the longer term trend of the ISM services and manufacturing indexes, both are actually pretty muted when you look at the last 15 years of data. So here you can see the historical average is probably close to 54, 55% for both the services and manufacturing sectors. Here we have 52 and 48, both are below these long-term historical averages. So although we've seen services hold up a lot better than manufacturing in the last few years, both are actually below average when you look at the last 15 years. Moving along in our week with much of the government economic data on hold right now due to the shutdown, a lot of economists, investors are looking at the sort of private sector data points like the ADP jobs report, as well as the Indeed job openings that we'll take a look at in the next slide. These definitely contributed to some of the cracks that we saw in the economy and the market last week, as we only added 42,000 jobs in the month of October. Now, this was slightly better than expected, but this is the first monthly gain since July in jobs added, and it's also very mixed when you look at the sectors. So job gains were concentrated among large employers with more than 500 employees. Hiring was pretty mixed among small and medium-sized businesses. By industry, the strongest job growth came from trade, transportation, and utilities, which is a strength there that is more of a cyclical industry in many respects, up 47,000 jobs. Education and health services up 25,000 jobs. That's more of a acyclical, non-cyclical industry there. Financial activities, this was a positive, but that was up 11,000 jobs. But then when we look at the negatives, we have information, aka largely technology jobs, down 17,000 in the month. Professional and business services also down pretty heavily in the month. And then other services also down pretty heavily in the month of October. So it did come in overall better than expected, but there's certainly some cracks when you look through some of the smaller trends within the data. On top of the ADP jobs report, we also got job openings from the platform Indeed. It showed that as of the end of October, job postings on Indeed fell to their lowest level since 2021, with the index at 101.7. You can see the last time we were at this range here was 2021, recovering from the pandemic. Indeed also reported a notable regional decline in job openings around Washington, D.C., obviously tied to the government shutdown. Finally, wage growth in job postings continued to slow, easing to 2.5% year over year, according to their wage tracker. Overall, the data points to a continually softening labor market, with both hiring demand and wage pressures losing steam. Last but not least, the University of Michigan's Consumer Sentiment Index came out last week as well. It fell pretty sharply in the month of November, down 6.2%, and it was nearly 30% lower than a year ago. You can also see we're at the lowest level since 2022, so more than a 3-year low there, and we've actually been lower than the April-March sell-off earlier this year. So pretty substantial drop in consumer sentiment. The prolonged government shutdown has begun to weigh on consumers, it seems, with sentiment weakening across all age, income, and political groups this month. One notable exception, though, to weaker household sentiment came from households in the highest tercile of stock ownership, where sentiment was actually up 11% in the month, supported by obviously strength in equity markets that seem to be weakening towards the end of the week, but have been pretty strong through October and into the first few days of November. Overall, you can see sentiment is very weak. We're actually very close to an all-time low in sentiment, underscoring the widening gap between Wall Street and Main Street. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.